All right, today we're going to dive into something pretty wild. The virtual worlds that central banks build to test out their biggest, most impactful decisions. We're going to break down how these massive economic simulators actually work, and more importantly, why they matter for pretty much everyone.
You know when you're watching the news and they talk about the Fed fighting inflation? It always feels like this incredibly high-stakes balancing act, right? Like walking a tightrope. One little misstep and you could send the whole economy tumbling into a recession. But if you don't move at all, prices could just spiral out of control. Well, that feeling of pressure and uncertainty, that's exactly what central bankers are dealing with every single day.
So, to really get a grip on how they handle that tightrope walk, we're going to break this down into 5 parts. First, we'll look at the simulators they build for the economy. Then, we'll check out the simple rulebook they came up with. After that, we'll uncover a hidden and kind of scary flaw in that rulebook, see how they take the economy's temperature, and finally, we'll connect all this virtual stuff back to reality.
Okay, so let's just start with the biggest challenge right out of the gate. How on earth do you test drive an entire economy? I mean, we're talking trillions of dollars and millions of jobs. You can't just try something out and see what happens, right?
For the longest time, policymakers were basically flying blind. Any decision they made about interest rates was based on some theories and a bit of history, but they had no way to really simulate what might happen next. Think about it. It's like asking a pilot to land a 747 in a hurricane without them ever having used a flight simulator. The stakes were, and still are, just massive.
And that's where these things called DSGE models come in. Yeah, I know it's a mouthful. Dynamic, stochastic, general equilibrium. But really, you can just think of them as the economic flight simulators that central bankers were dreaming of. They are incredibly complex virtual economies, built from the ground up to test drive policies before they're unleashed on the real world.
So what's actually in one of these simulators? Well, it kind of boils down to 3 main pieces. First, you've got your digital households, all programmed to try and make themselves as happy as possible, by deciding how much to work, spend, and save. Second, you have digital companies that are all about maximizing profits. And third, you have a central bank that's in charge of setting the rules, like the main interest rate.
But here's the secret sauce, the one little quirk that actually makes the whole thing work like the real world. The model has a built-in friction. Prices are sticky. Think about your local coffee shop. They can't just change the price of a coffee every 5 minutes, right? It costs money to print new menus, and you'd probably annoy your customers. That little bit of real-world inertia is absolutely crucial because it's why changing interest rates has such a big impact.
Okay, so now you've got this amazing economic simulator. What's the first thing you do? You start testing out strategies to see what works best. And for years, pretty much everyone agreed that there was one golden rule for keeping inflation under control.
That rule is called the Taylor Principle, and the idea behind it is actually pretty simple, but really powerful. It just says that if inflation ticks up by 1%, the central bank needs to raise its main interest rate by more than 1%. The whole point is to make it more expensive to borrow money, which should cool down spending and get inflation back in its box.
See, by jacking up rates more aggressively than inflation is climbing, you're not just tapping the brakes on the economy, you're sending a powerful message. It tells everyone that you're serious about keeping prices stable, and that helps stop people from expecting higher inflation, which can become a self-fulfilling prophecy. For a very long time, this was seen as the playbook for a stable economy.
But here's where our story takes a turn. What happens when your own simulator starts telling you that your perfect rulebook might be broken? The research we're looking at today found a critical flaw, a hidden feedback loop where this simple rule can go horribly wrong. This really gets to the heart of the matter. What if this rule we've all trusted, this Taylor Principle, what if it has a bug, a really dangerous one? What if trying to follow the rulebook too closely could actually make the inflation problem even worse?
This is where a concept called the working capital channel comes in. And look, it sounds academic, but it's based on a super simple business reality. Most companies have to borrow money just to make payroll and buy supplies. They have to spend that cash before they actually sell anything and make it back. So for them, the interest rate isn't just some abstract tool, it's a direct cost of doing business.
And this is where things can get completely backwards. The model simulations show that if businesses are really dependent on those short-term loans, then hiking interest rates too hard can seriously backfire. It drives up their costs so much that they have no choice but to raise their prices. That higher inflation then signals the central bank to raise rates even more. The very tool meant to fight inflation ends up adding fuel to the fire, creating a vicious cycle that can push the whole economy into an unstable zone.
So obviously you need to know if you're about to trip that wire, right?
You need a good dashboard for the economy's health, a way to know if it's running too hot or too cold. And that's another thing these models are great for. They help measure one of the most important vital signs of the economy.
That vital sign is called the output gap. And all it is really is the difference between what our economy is actually producing and what it could be producing if everything, people, factories, technology, was running at full, sustainable steam. A positive gap means you're running too hot, risking inflation. A negative gap means you've got slack and you're wasting potential.
This chart here makes it super easy to see. If potential output is 100%, but actual output is only at 98%, well, that 2% is your gap. It's slack in the economy. And believe me, this little number is a huge deal for policymakers. They watch it like a hawk to decide whether they need to hit the gas or pump the brakes.
Okay, so we've covered a lot: simulators, rule books, economic dashboards. Let's bring it all home and talk about why any of this abstract stuff really matters to you, me, and our wallets.
Look, at the end of the day, these models are not just some fun little game for economists. They have real-world teeth. The decisions guided by these simulations directly affect the rate on your mortgage. They influence policies that create jobs or don't. They show us that simple rules don't always cut it, and that understanding these weird, hidden feedback loops is everything. These are the virtual labs where the biggest economic debates of our time are actually happening.
And that leaves us with a pretty tough thought to chew on. We've built these incredible tools to try and see the future, to help us steer this massive, complex thing we call the economy. But we've also learned they have their own blind spots. So the real question is, if even our best crystal ball is flawed, how can we ever be truly sure that we're on the right path?